Hello class, this is Dr. Fenton. In this video, we're going to talk about long-term assets. So let's get started. Now, when we acquire property, plant, and equipment, and these are what we call long-term assets along with land, then what we need to do is record the long-term asset at its cost that we're paying for it, plus all the necessary expenses that we need to incur to get the asset ready for our intended use. So let's look at land first of all. So when we buy land, we say what we call capitalize the land. That means we place the cost of the land into an asset account. And the asset account will be called just what it is, land. We'll place the cost of the land itself in that account, and also anything else that we incur to get the land up to where we need to use it. So you can see here in the green highlights, any additional expenditure such as clearing, filling the land, leveling the land, even removing an existing building that you don't want anymore to prepare the land for its intended use becomes part of the land's capitalized cost. So in other words, we place all those costs into the land account. So we might see some land that we want for our business. It has an old building on it that we really don't want, but we want the land. We'll do, buy the land, pay the commissions or whatever. All that goes into part of the cost. Title transfer goes in and so forth. But then we have to remove an old building because we just want to knock it down and then build our own new building. So the cost of removing that old building, knocking it down and hauling off the scrap is part of the cost that we put into the land account. Here's an example. So we have the purchase price of the land itself is $500,000. We had to pay commissions of $30,000 to buy the land. We had to pay back property taxes. Now what this means is that the previous owner owed some property taxes, and just to get the transfer done, we agreed to pay the other person's back property taxes because we wanted the land so bad we were willing to do that. That goes in as part of the cost of the land also. Now any future property taxes that we pay when we own the land, that is just, taken to the expense account, this property tax expense account. Title insurance, if you buy that, cost of removing the existing building. And then the highlight I have here is salvage materials from existing building. So we got a lot of wood out of the old building, maybe, other scrap and so forth, and we were able to sell part of that and get some money out of it. That reduces the cost of the land because we're getting some money out of this, and so this is why this is a reduction of $5,000. All these are additions, and now we have a reduction because we're getting some money back on the old building that we knocked down and sold for scrap. Then we had to level the land, so $6,000. So we will include all this into the land account. So if you were paying cash for all this, or receiving cash or whatever, you'd be debiting the land account for $590. You probably would debit the cash account for the cash that you got from the old building, and then all the other costs will be credited. Probably you're paying cash to have that stuff done or to buy the land. Okay, so you capitalize more than just the cost of the land itself, the $500,000. You have all these other expenses and a little bit of cost savings involved in buying the land and getting the land ready for your intended use. Now, land improvements are different. These are parking lots, sidewalks, driveways, fences, sprinklers, and so forth. These are not included in the cost of the land. These are placed in their own separate account. You can call the account land improvements, and they will be depreciated over their useful lives. We'll talk about depreciation in a few minutes. For buildings, similar to the land, the cost of the building usually includes commissions we're paying, the legal fees and so forth, title transfer. All that goes into the cost of the building. If we build our own building, then we're going to pick up the cost of architect fees, materials cost, construction labor, and also costs such as manager supervision, overhead cost, that relate to the construction, and interest we paid during the construction period. All that would be included in the cost of the building. So it's not just the building purchase price, but other costs involved, or if we build the building, we have a lot of other things we'll add into the cost of the building itself. Equipment is similar. The equipment will be the cost of the equipment, the actual purchase price, plus anything else that we're paying for, such as sales tax, shipping to get the equipment to our place of business, delivery insurance if we pay it, assembly, putting it together, how much did it cost for that, installation, testing, even legal fees if there's title involved in this equipment. So just like the other two, land and buildings, when you buy equipment, usually you're paying for more than just the actual list price of the equipment. You have all these other costs, and they will be included in the cost of the equipment. Now, after you buy the equipment, any cost like property insurance, annual property taxes, repairs and maintenance, all that is expensed. It's not included as part of the cost of the equipment. Let's look at an example right here. So if we have equipment that costs $82,000, put it down. Sales tax, transportation to get to our place of business. We paid shipping insurance, and then we incurred cost of $1,500 to install it, and that even includes test runs. Get it to where we're going to start using it to produce the product we're going to sell. So $91,000 would go into the equipment account. Now on a basket purchase, this is when you pay one price, but you're buying several assets. So you might buy land and building and equipment and agree upon one price and write one check. So you're buying three different assets: land, building, and equipment. But we have to divide the overall cost. So if we paid $900,000 right up here for these three assets, we have to divide up $900,000 among the three assets. That's what we're doing in this schedule down here. So here's the $900,000, and here is how much is allocated to each of those three assets. So how do we get these numbers? What we'll do is appraise each asset separately, and then add up the appraisal value, the fair market value. So if it's, someone tells us what you purchased was worth a total of $1 million, we paid $900,000, but they value out separately at a total of $1 million, and that the land was valued at $200,000, the building $7,000, the equipment $1,000, you'll use these numbers to allocate the cost of the total purchase. So what you'll do is take the land, $200,000, over the total $1 million fair market value. So 20%, and this is 0.2, 20% of the price we paid is allocated to the land. Yes, the land's worth $200,000, an appraiser says, but based on what we paid for it and the percent of the total value of these three properties, only $180 is allocated to the land. Do the same thing for the building, $700,000, its fair market value over the total, $700 over $1 million, 70% times 900, $630, and the equipment $100,000 divided by $1 million, 10% times $900,000, $90,000. So this overall purchase price of $900,000, and let's say we wrote one check for that, we split it between the land, building, and equipment. We split the cost, but we do use fair market values over here, but we only use fair market values to help us decide how much of the cost goes to each of these three assets. And natural resources, these would be like iron ore, oil, natural gas, timber, and so forth. We have separate accounts for those. We will, separate asset accounts for those. And then when we extract that natural resource out of the ground and sell it, we will what's called deplete the amount. We're depleting the resource, and we'll write off the cost of that asset called depletion. So we're depleting that resource. Next page. Intangible assets. You probably know these are assets that have no physical value: patents, trademarks, copyrights, franchises, goodwill. They have no physical substance, but they do have fair market value. Part of this could be brand value. You can see that this was like 3 years ago. I know this has changed. but Apple was the #1 brand value, 181, and this is probably in millions, this in billions here. So $181 billion was the brand, the Apple's brand was worth. Google, 141. So what we'll do is when a company acquires intangible assets, we do have to set up separate accounts for these. So when an asset is purchased, like patents, copyrights, trademarks, we will record the cost of that purchase in that account. We'll have an account called patents. We can have an account called copyrights. So whatever account you need, you can set that up. If a company develops the intangible asset, then the process of obtaining a protective patent, that could be capitalized in that asset account. Now here, when we purchase it, we set it up at the original cost, what we paid the previous patent owner, let's say, if we purchased a patent, and then legal fees to get the transfer done, and anything else that we need, that we incur so that we can own this intangible asset, whatever it is, copyright, patent, or whatever. Now, when we incur our own research and development cost, we might be, developing a new product or whatever. We might patent that product. But what we do, we go ahead and expense the R&D cost, research and development cost. That's because sometimes it's awful hard to identify certain R&D costs for certain items that we invented. Also, sometimes it's hard to tell how much of the R&D cost would benefit future periods. So we just make it simple. The accounting rules make it simple. Any of your own research and development costs are expensed immediately to the income statement. Now, patents, you know what that is. The patent gives the patent owner a right of 20 years, and it may or may not be valuable for 20 years, but after 20 years, then the patent is, that process or whatever is open to anybody. Okay, so patent is good for only 20 years. If we purchase it, then what we'll do is record in a patent account, which is intangible asset, the cost plus legal fees, filing fees, and other fees to secure the patent. Now, a firm could develop a new product and patent that product or whatever, but again, most of the R&D cost would be expensed to the income statement. Legal expenses, they would be capitalized, but the research and development cost would be expensed. Copyrights, these are good for the life of the creator plus 70 years. So these are good for a long time. So you might develop your own copyright, which you probably will not have then a cost to capitalize. But if you buy it from someone else, then again, the cost incurred would be included in an account we can just call copyrights, another intangible asset. Trademarks, if you have these, and you can set these up, the cost of these, when you register these, you can set these up in another account called trademarks. And franchises, if you purchase a franchise, then sometimes you have to pay that initial franchise fee. You set that up as another asset. Now, goodwill is something different. Goodwill, as the first highlight says here, is recorded only when a company acquires another company. So goodwill is recorded by the acquiring company for the amount that the purchase price exceeds the fair market value of the acquired company's identifiable assets. What does that mean? Let's look at the example. We have the Ritz Produces company, and we look at the balance sheet. And this is a slimmed down balance sheet that's used when you buy a company. You want to know the assets that you're buying, and you want to know the liabilities that go along with it. So you have these quotes on these. The appraisal is done on the equipment and the patent, and the equipment appraised out at 32, the patent at 8. The accounts receivable should be the net realizable value after you take away bad debts, potential bad debts. So assets, fair market value 50. And this is in millions of dollars, so $50 million. Liabilities that go along with this business that you'll have to pay will be $9 million and $15 million for 24. So what you're doing, if you buy this business, You're buying the business that has identifiable net assets of only $26 million. The 50 assets minus the 24 liabilities. So you're buying what you can see there, a net asset, that's why they say identifiable net assets, of $26 million. But the purchase price is $36 million. Now, why would you pay a lot more for a business when you're buying only these assets and these liabilities go along with it? Why are you paying, in this case, like $10 million more? That's because it already has a name brand, a location, customer base, and so forth, and you believe it's worth $10 million more than what you can just see on the assets. Those are the assets that you can identify. This is called goodwill, the amount that you pay above the identifiable assets. Here's what you have. Purchase price 36, the identifiable assets net out to 26. Goodwill is 10, in this case $1 million. These are millions. Here's the entry. You're going to record receivables, you purchase those, the equipment, fair value, patent, fair value. Skip this for a second. Record the accounts payable. You're acquiring these, you have to pay these off. Note payable, you pay these off. You pay cash at 36. Get all these entered, and you'll find out you still need a in this case, $10 million debit to balance the entry. That's the goodwill. And call it what it is. New account set up, intangible asset, goodwill. So the purchase price of a business over the net identifiable assets, that's goodwill. Now, if you start your own company and you run the company for like 20, 25, 30 years, it's a good company, well-known, good customer base, very successful. You have your own goodwill built into the company. But you never record your own goodwill. Like we said at the very beginning up here, remember this, right here, goodwill is only recorded when one company acquires another. So you might have your own business. It does have goodwill, but you never record your own goodwill. So keep that in mind. Next page. Expenditures after acquisition. Now, once you buy an asset, you might have costs that you incur that you need to add to the asset account. That's what we say capitalize an expenditure. We add it to the asset account it relates to. You will do that if it increases future benefits. We expense an expenditure related to an asset if it generally only benefits the current period. Okay, so what do we mean by this? Well, let's say we have a delivery truck, and so a tune-up, an oil change, a repair of a minor engine part or whatever, those are ordinary necessary repairs. You'll expense those. Just repairs expense. That's fine. Now, if you incur a larger expense that benefits a future period, like if you overhaul the engine or put a new engine in the vehicle, that's a major expense. It benefits a future period. You would add that cost of, let's say, that new engine into the asset account and expense it off over its useful life. That's called depreciation. Any additions, a major component or whatever, you would add that to the cost of the asset, again, if it benefits a future period. Improvements, the same way. Again, capitalize it if it'll benefit future periods. Legal defense of intangible assets. A lot of times, we see people copying our patent, violating copyrights or whatever, and we get into a legal battle, with someone. If we lose the legal battle, then we just expense off the legal fees. If we win, then we capitalize the litigation cost to the asset it relates to. So you show it as an asset. So it depends on if you win or lose the lawsuit on how you handle the legal expenses. If you win, capitalize them, add them to the cost of the asset. If you lose, expense them immediately. Now, materiality is a concept that after a certain dollar amount, then it would have an impact on someone's decision about the company, whether it's a stockholder who wants to sell stock, a new stockholder wants to buy stock, a creditor who might loan money to the business, And so any item that's material, it needs to be recorded the, quote, correct way. And the correct way is what generally accepted accounting principles will tell us to do. Okay? But sometimes a cost or an item is so small, you can handle it the easy way instead of the theoretically correct way because it doesn't make a difference. For example here, if you buy a $10 stapler, it might last 20 years, maybe longer. So should you set up $10 into an asset account and then depreciate the stapler off over a 20-year period? Well, if you did that, and we're going to talk about depreciation in just a few minutes, but that would be taking $10 spread over 20 years, 50 cents a year depreciation expense. That's not worth the trouble. That $10 cost at the beginning, you can just expense that off immediately. Yes, theoretically, it should be capitalized because it'll benefit future periods, but the cost is so small, it doesn't make a difference. So handle these things the easy way and just expense it off. What cutoff is material for a company? It depends on the company. Some companies might say anything below $1,000 in material, handle it the easy way, expense it. Some companies might say $5,000, $10,000. If you have a multi-hundred-billion-dollar company, $10,000 is nothing. And they might just, expense something instead of capitalize it. So review this illustration here when you have the chance. And here's an example you can go through on your own. Cost allocation. This is where we get into depreciating the assets that we've purchased. Now, whenever a lot of us think about depreciation, like for example a car we might be driving, the dictionary depreciation, or definition, is decrease in value. So we might think, well, this depreciation is the car going down in value. That's true. You might think of like the Blue Book value on a car. That's the fair market value. But for accounting, we have our own definition of depreciation. So the accounting definition is the allocation of an asset's cost to an expense over time. That means you're going to write off the cost of that asset over its useful life. We're going to see how to do that in just 1 second. Got a little more. Whoops, too far. And we use depreciation to describe the process when it applies to property, plant, and equipment. When we write off an intangible asset cost, it's called amortization. So we have depreciation and we have amortization. So again, depreciation in accounting is allocating, in other words, writing off the cost of the asset over as an expense, depreciation expense, over its useful service life. A little chart right here. You pay for something today, it might benefit 4 periods. So you'll take the cost you pay today and expense it off over 4 periods. You'll capitalize it at the very beginning, like debit equipment, but then you'll depreciate it off over 4 years and spread that cost over a 4-year period. So let's say that Starbucks pays $1,200 for an espresso machine, and it usually lasts 4 years. What we'll do then is take the $1,200 divided by 4 years, and we have $300 a year depreciation. So we're going to write the cost off over 4 years at the rate of $300 per year. Here's the adjusting journal entry. Debit depreciation expense, and then credit accumulated depreciation. The depreciation expense account in this entry is just like any other expense. It goes straight to the income statement, so no problem there. But the accumulated depreciation account is a new type of account for us. It is sort of similar to the allowance for doubtful accounts we had earlier, the bad debts. It is a contra asset account. So accumulated depreciation goes along with the asset that it relates to, like in this case equipment. It is a separate account, but it has a credit balance, and so we will net it against the asset account, like down here. The equipment cost $1,200. If at the end of the year we've recorded 1 year depreciation expense, we've placed $300 into an accumulated depreciation account, we subtract, and so the equipment now has a book value of $900. Book value is simply this: original cost less accumulated depreciation. And that's all the cumulative depreciation you've taken to date on that equipment. So here, book value after the first year is $900. So accumulated depreciation has a credit balance account. It is not a liability. We don't owe anybody any money on this. It is a contra asset account. So we don't credit the equipment account here. We credit accumulated depreciation. You know, a lot of people try to credit the equipment account because they say, when we bought the equipment, we debited, equipment. So when we write it off, we should credit it. No, we credit accumulated depreciation. So again, book value, also called carrying value, equals the original cost minus the current balance in accumulated depreciation. After 2 years, if we've taken 2 years depreciation on this asset, we now have $600 in the accumulated depreciation account. Subtract that from the equipment, original cost of $1,200, book value is now $600. So every year after we make that adjusting entry, then we have a lower book value. And each year book value will drop by $300. And then at the end of 4 years, we've written off the entire amount of the equipment. The book value will be 0, because we'll have equipment $1,200, accumulated depreciation 300 times 4 at the end of 4 years, $1,200, book value would be 0. Here's some terms we need to become familiar with as we start talking about how to calculate depreciation. Service life or useful life, the estimated use of the company, the estimated use the company expects to receive from that asset before disposing of it. How long will this asset last this company? Some companies might have a longer life, they don't use the asset as much, but it's this company, like your company, how long do you think this asset will last? This is an estimate, so we're getting the estimates here. The residual value, what do you think you can receive from selling the asset at the end of its useful life, the service life? Again, this is an estimate. And depreciation method, this is the pattern that we use. Straight line, it can be accelerated and so forth, but we have to select a certain depreciation method to spread the cost of the asset over its useful life. Now, for our purposes, test purposes, we are only going to concentrate on straight line depreciation. For straight line depreciation, we're going to allocate the cost of the asset equally over its useful life. So we'll have equal amounts each year. And that just implies we're using it evenly over its useful life. That may or may not exactly be the case, but it's the simplest and most common depreciation method used in financial accounting. There are other methods here, declining balance, activity-based. Don't worry about it for our course. Just concentrate on straight line depreciation. So let's see how this works. Here are the numbers. Let's say we purchased a truck that cost $40,000. The estimated residual value is $5,000 at the end of 5 years. We'll need 100,000 miles here if we were using the activity-based depreciation method. We're not going to use that method, so don't worry about the 100,000 miles. We're just going to use the 5 years. So we need to spread the cost of this asset over a 5-year period. Here's the entry, or here's the formula for depreciation expense. Look at the numerator. We put the asset's cost up here, but we also subtract the residual value. We only depreciate what we call the depreciable cost, and that's the original cost minus our estimated residual, or I'll call the salvage value at the end of its useful life. And the surface life, useful life, is in the denominator. Let's plug in these numbers. So 40,000 minus 5,000 divided by 5 years. So our depreciation expense each year, each of the 5 years, is going to be $7,000 per year. And just we're going to see a 0.2 or 20% here in a minute. So 5 years, 1 over 5, this is the 5 years, is 0.2. So you can use a depreciation rate of 20% or 1/5. That's the same thing as dividing 5 into the number up here. And the residual value, like it says here, is never depreciated. So here's a schedule. Here's why I wanted to talk about the 20% 0.2. This is the depreciation rate, which is 1 over the useful life. 1 divided by 5 equals 0.2. So $35,000 is the depreciable cost times 0.2 equals $7,000. We saw that earlier. At the end of the first year, that is the accumulated depreciation. So at the end of the first year, the book value is $33,000. $40,000 minus 7 gives us 33. Second year, same calculation, same depreciation expense. It'll be the same each year. At the end of this year, after the adjusting entry, the accumulated depreciation account will have a balance of $14,000. This is not saying here that we're going to credit accumulated depreciation $14,000. Here's the number for the entry. If you remember the entry, we debited depreciation expense $7,000 and credited accumulated depreciation $7,000. That'll be the same adjusting entry at the end of every year. As we do that, our accumulated depreciation account will go up each year by $7,000. Our book value will decrease each year by $7,000. At the end of the fifth year, make this entry. We now have $35,000 in the accumulated depreciation account. Our book value is now $5,000, and that equals our residual value. Okay, so straight line depreciation, the depreciable cost, which is original cost minus residual value, in this case 35, times depreciation rate, 1 over 5 or 0.2, and gives us the depreciation expense. This is assuming we had the asset the full year in year number 1. Partial year depreciation comes into play when we buy the asset in a month later than just the first month, like January. So this example here, let's say that we purchased the asset on November 1st instead of the first of the year. We cannot take a full year's depreciation then if we buy it sometime in the middle of the year. And this is towards the end of the year, in fact. So we only have 2 months to the end of the year, November and December. What we need to do then is take what would be otherwise a full year's depreciation, $7,000, calculated the same way we did up here, but now take that times 2 months over 12 months. And so 1,167 will be the entry for the adjusting entry, the number for the adjusting entry for depreciation at the end of this first year. Why? Because in the first year, we only used the equipment 2 months. So we can only take 2 months depreciation. Now the next year, the following year, second through fifth years, we'll still take $7,000 depreciation expense the full year. Then you kick into the sixth year, and we have 10 months depreciation, and that will be the $7,000 for 1 year minus what we took the first year, and that's $5,833. So we still take the full $35,000 depreciation expense, except we have a smaller amount in the first year, and then some of it spills over into the sixth year. But we still use the $7,000 full year for the second, third, fourth, and fifth years. Don't worry about change in depreciation estimate. You're not going to be tested over that. And don't worry about these depreciation methods, declining balance. Don't worry about activity-based depreciation. And let's see, the rest of it, yes, don't worry about the rest of this page. Next one. Amortization of intangible assets. Now, amortization is sort of like the depreciation for the property, plant, and equipment that we had, except when we write off the cost of an intangible asset, we call it amortization. So most intangible assets have a finite useful life. We can estimate that. So if we can estimate it, what we do then is write the cost of that intangible asset off over its useful life to us. Now we might have a patent that lasts 20 years, but if it's in technology that means the patent might be good for only 7 years, 8 years, or whatever, we write the cost off over what we think is the actual useful life of that patent. Not the legal life, 20 years, but the useful life. And like most companies, we will use straight line amortization. Same amount per year, take it divided by number of years. So let's look at an example right here. Here we have a franchise, and then Little King's Sandwiches purchased franchise rights for $800,000. And it's for a period of 20 years. In addition, they purchased a patent for a meat slicing process of $72,000. So 2 assets were purchased. Okay, in fact, 2 intangible assets. The franchise, $800,000, good for 20 years, and the patent for a meat slicing for $72,000. And let's see, the patent, 12 years remaining. It was 20 years, 12 years remaining. However, because of technology, the company thinks that the useful life of the patent is only 8 years. That's the one they're talking about here, the patent. Patents have a life of 20 years. When we bought it, Little King here, when we bought it, it had 12 years remaining, but we think it'll really only be good for 8 more years. That's what it'll be useful for us. Okay. Here are the entries we'll make to amortize these intangible assets. For the franchise, we paid $800,000. It's for 20 years. So divide $40,000, debit amortization expense, not depreciation, amortization expense, $40,000. And here we do credit the asset account itself. We don't have an account called accumulated amortization. We don't have that. So we do go ahead and credit and reduce the franchise account. There's the first entry. Now for the patent, we paid $72,000. We think it's going to be useful for only 8 years. So divide $9,000 per year is the amortization expense. So this will be the adjusting entry for the patent. We do reduce the patent account also by the $9,000. So these would be adjusting entries we'd make at the end of the year for these 2 intangible assets. So you keep the intangible assets separate. You have a franchise agreement you purchased, then you have a patent you purchased. Keep those costs separate. They'll have different useful lives to you. We have certain assets, intangible assets, that are not subject to amortization. Here's a list. We don't amortize those. Goodwill and trademarks. We don't amortize those. It would be very, very difficult to put a useful life on these 2. So we don't write these off. These we will. Okay. Patents, copyrights, trademarks, and franchises. These are trademarks with a finite life. Trademarks with an indefinite life we don't write off. Okay, so a little bit of difference there. Trademarks could be or might not be written off. Depends on the situation. Let's look at asset disposition. We'll look at just the first 2, the sale and retirement of assets. So whenever we sell an asset that we have, a long-term asset, we usually have either a gain or a loss. A gain occurs when we sell, our selling price of an asset is more than the book value, the book value of that asset. A loss occurs when we sell the asset for less than its book value. We talked about earlier, book value is the cost of the asset minus accumulated depreciation. Let's put all this together when we sell an asset. So here's an example. Going back to that same delivery truck. We were expensing it off over 5 years at $7,000 per year. But now let's say at the end of 3 years we decide to sell it. So at the end of 3 years we sell it for $22,000. We have a gain of 3. So how do we get the gain of 3? Here's the selling price, $22,000. The original cost of the truck was $40,000. If we've held it for 3 years, that means we've taken 3 years depreciation, and at $7,000 per year, we have $21,000 in the accumulated depreciation account. So now find the book value, $40,000 minus 21, $19,000 is the book value. We sold it for more than book value by $3,000, that's a gain. So selling this asset for more than book value, we have a gain. Here's the entry. We have cash coming in the door, debit cash $22,000. Then we take off the equipment account and the accumulated depreciation relates to it. So we take off the 40, credit equipment, reduce accumulated depreciation, 21. Remember, accumulated depreciation has a credit balance. So to reduce that account, we debit it $21,000. Then we have a gain of $3,000. Okay, it balances the entry. So cash, accumulated depreciation, equipment, then record the gain. It balances the entry out, and we can prove it two ways. Calculate it here and in the entry, and that shows us we do have a gain of $3,000. Sometimes you'll see this called gain on sale of equipment. It means the same thing. Let's change the selling price. Let's say we sell it for $17,000 instead of $22,000. Sales price $17,000. This part doesn't change. Same book value. We bought it at $40,000. We had 3 years depreciation, $21,000. Book value still $19,000. We sold it for $17,000, so we have a loss of $2,000. How do we record the loss? Cash comes in the door, debit cash $17,000. This is the same, still debit accumulated depreciation $21,000. This is the same, credit equipment $40,000. Now we need a debit to balance the entry, and the loss is the debit, $2,000. And you can call this loss on sale of equipment if you want to. But losses are always debited. Gains are always credited. It always works out that way. So again, you have a gain when you sell the assets for more than book value. Remember that. Now, retiring a truck or an asset just means you're not going to use it anymore. Maybe at some point it became worthless. You couldn't use it. You just threw it away. You did not sell it. So if you do the same thing here, now you retire it, same numbers to begin with, but retire it, we don't get any money. The book value is the loss. No cash is coming in the door. The entry is easy. There's no cash to record. Take off accumulated depreciation. Take off the equipment. Our loss is larger, $19,000. So when you just like throw an asset away or give it away or whatever, then your loss is the book value at that point in time. Don't worry about the exchange of long-term assets. Asset analysis. In this section, they're looking at Walmart and Costco. They're the numbers from, I'm not sure what year that was from the annual reports, but a few years ago. And the first one here, return on assets. This is just trying to see how well you're using your assets to generate net income. And we're going to use average assets. And we're going to take the beginning of the year assets, end of the year assets, add them together, divide by 2, just a simple average. Divide that into net income, and this is the return on the assets you have invested in your company. So down here, if Walmart has net income, and this is in millions, so over $14 billion, divide that by average assets, 199 billion right here, average assets. Return on assets, 7.2%. So they have all these assets invested in the company, and they're earning 7.2% on those assets. Cost goes a little bit higher, 7.7%. So this is a way to reflect how efficiently you're using assets to generate net income. Now, profit margin and asset turnover, these are two components of the return on assets. Profit margin, asset turnover. Profit margin is just simply net income divided by net sales. And this tells you a percent, for every sales dollar you have, what is your net income? What percent is your net income? What percent of your sales is your net income? Asset turnover, how efficient are you in using your average assets in generating sales? That's what this is showing you. To calculate for those two companies, profit margin, so our income divided by net sales, 3%. This means that for every $1 of sales Walmart has, then 3 cents, 3% of a dollar, 3 cents is profit. Costco, a little bit less, just 2.1 cents per dollar of sales. Asset turnover, this just means, in a way, how efficient you are in raising revenue, sales on the assets you're using. So average assets again, divided into net sales, 2.4 times, Costco, 3.7 times. And that's it. Let me see. Yes, don't worry about this part, asset impairment. Chapter highlights, you can look at this on your own. And that's it for this chapter. Okay, it gets into the end of chapter material. So again, another detailed chapter relates to buying long-term assets, intangible assets, and then how to depreciate assets and how to amortize the intangible assets. Then we finish with selling the assets themselves and a couple of ratios thrown in. All right, so good luck with your studies.